Dividend investing or covered calls. In this video, I'm going to be talking about both of these investing strategies, both with the same objective of boosting income by utilizing your existing money. In case you guys are new to this channel, I'm Mark Berti, and I help people just with some videos time to time about different investing strategies and some of the stuff that I am doing. So dividend investing is the option that is more familiar to people. Basically, you pick a dividend stock, it keeps paying the dividend every quarter, which is what most companies do. Some do semi-annually, twice a year, some do monthly. And while each company is different, again, most are going to be quarterly. A lot of the good dividend stocks, they will raise their dividend each year. So let's say you're making $1 per year through a dividend stock, which is 25 cents per quarter. Let's say that next year they decide to raise it to 28 cents per quarter, which is $1.12 per year. You didn't do anything extra, but you're getting extra dividend payments because companies that pay dividends like to raise them each year because it's a sign to shareholders like, hey, we're making progress, we're building, our business is still good. But if a company decides to cut their dividend in half or remove it entirely, the stock price typically plummets because if you are cutting your dividend or you're not growing it, a lot of people take that as a sign that, it's not entirely smooth sailing with the stock. Dividend investors, they like to keep stocks, hold them for a while and keep receiving the dividend payment. If they get a little jittery and they are not sure if the dividend payment can be maintained, then more people abandon ship. You could look at something like the dividend payout ratio. If it is higher than 80%, there is a cause for concern. Anything like I'd like to go 60% or lower for the dividend payout ratio. Pretty much what that means is for if you have a 60% ratio, then for every dollar you make in net income, 60 cents of that goes towards the dividend. That's what that pretty much means. And the reason that companies pay dividends is pretty much, we don't know what else to do with this money. Okay, let's just give it to our shareholders who have been investing in us, and let's just keep on raising that number. So part of the issue with dividend stocks is that if you have a higher payout ratio, and sometimes the payout ratio is like, okay, you can still pay like the dividend and the company's fine, but it usually indicates that the company is heading towards maturity, where you're not going to see as much of the big time growth. You're not going for that type of game. You're not going to get the Shopify returns or the Amazon returns. You're hoping to get some type of modest return, but the dividend is why you are really there. And one big weakness with dividend investors is to just look at the income they are making and not really think about the appreciation. So AT&T remains a very popular stock because it has a very juicy dividend yield. But if you look at the way it's performed in like the last 10 years versus the way that the market has performed, most like other stocks have performed, AT&T overall is not in a very good spot. So sometimes you could get trapped by a juicy dividend and then end up with a stock that barely appreciates or even depreciates. I mean, IBM, for instance, 10 years, pretty much the same exact price. And sure, the dividend's looking really good now, a little over 5% yield. But at the end of the day, it's like, how much money did you put in? How much money did you get out? That's not to say all dividend stocks are bad, as there are plenty of good ones that have safe dividends, that have stock appreciation, and are set to keep raising that dividend for years to come. So one year you could be making $100 through dividends. Next year you could be making $110, even if you don't buy another share. Now, the cool thing about buying shares is that each dividend payment can become more shares. You reinvest, and this is a fantastic way to build up on the returns. If you are not reinvesting, you are missing out on the bulk of the returns that dividend investing provides. And some people, they can't reinvest because they do need the money, and dividend investing is a great retirement strategy to collect that passive income and not have to work as much. But you can leave money on the table, although it is less risky to go into dividend investing versus buying growth companies. So that's just dividend investing, a very brief summary, but covered calls is another strategy for income. Now, with a covered call, you need to have at least 100 shares of the company in order to initiate one, because you sell calls or you buy calls. Those are done in units of 100 shares. So if you want to do covered calls on Apple, you need to have 100 shares of Apple. And if you want to do you only have 150 shares of Apple, you can only do one covered call. If you want to do two covered calls of Apple, you would need 200 shares. So that's pretty much how the math works there. Now, the great thing about covered calls is that it allows you to get instant premium, and you can set out a strike price based on what you feel like doing. If you want to just abandon the stock because you don't think it's going to do well in the future, you feel like it's going to go down and you want to buy at a more attractive price, then you can set a strike price that is closer to the current price. So you collect premium and you get to leave the stock at the price point that you currently would be okay with leaving the stock. You could also set a further out of the money covered call where you're less likely to lose the shares. Although if you set further out the money and you lose those shares, you also get the appreciation on the way up to the strike price, but you do get a little bit of premium. And for a stock like Apple, it's very reasonable to get, depending on what your risk tolerance is, a 5 to 10% annual return just by selling the covered calls. Now, you can set a strike price where if you were able to implement this every single week, you would get something much higher, like a 20% return, a 30% return. But if you do go closer to the money, you have a greater chance at having to sell the shares and then missing out on potential gains. So let's say you buy a stock at $100 and you set a strike price at 110. If your stock goes to 110 or above, you have to sell those shares at 110 per share. And you get a premium for that, which, that's immediate money that you can either use to pay off expenses or buy other stock. The problem is that if the stock goes up to $120 a share before expiration, you still have to sell the shares at $110 per share. So that's the only downside. But again, you can set really far out of the money calls, and then I don't want to say that you fully shield yourself, because stock could pop up at any moment, but you significantly decrease the chance of the call getting exercised. Some people use this strategy as a way to complement their dividend investing. So Apple, for instance, people like its growth. They like the company, the dividend. Nobody goes to Apple for their dividend. That thing's like less than 1% yield. Like, nobody buys Apple solely because of the dividends. But in a covered call scenario, you can get a 5 to 10% as if it's a dividend, but it's not quite a dividend because it's different. It's premiums that you kind of have to pay a little bit more attention to, instead of dividend payments where you literally pay zero attention. All the stuff happens automatically. Covered calls, you got to just look at your portfolio a little bit each day just to monitor the whole situation. But it's good to know what both of these strategies are and to utilize them. I think long term, if you could pick between making a full-time income through dividend investing or full-time income through covered calls, you would want to pick dividend investing, because covered calls, it's like dividend investing is truly passive income. You just do research, you figure out the stocks you want, they keep paying dividends. The selling the covered calls, there is a little bit of work, not too much work, but just like the constant checking of the portfolio, make sure everything's going according to plan. That could, take some time and some stress. Like dividends is completely stress-free unless, you hear your company is going to slash a dividend or your company you're investing in is in trouble. That's why in any case, it is always good to diversify your portfolio to a degree. I feel like if you have index funds, like you're automatically diversified. So I'm not saying like buy a little bit of this sector, buy a little bit of this sector, buy what you know. And if you don't know a sector, like why are you going to buy into it? when you could just buy something like an index fund, which in my opinion automatically makes you have a diversified portfolio. I'd love to hear from you guys in the comments if you guys agree on that with the index fund, or what your thoughts are, dividend investing versus the covered calls. I do feel like both of them work really well. The covered calls, you can get to like making like whatever dollar per month goal you have. You can get there faster with covered calls than you can with dividends, but the covered calls do take some extra work. And if you do get the shares exercised, and you got to sell the 100 shares, you got to then proceed to do it with a cash secured put. So options is just a little bit more work. You get more income. Dividends is where the long-term play is at, but I see options as a way to get to making your money through dividend investing. So once again, I'd love to hear from you guys. Like this video if you enjoyed it, subscribe for more like this, and I'll see you guys next time.